Most people believe money in their bank account belongs to them, secured, protected, and immediately accessible anytime. That belief feels natural because banks market safety, stability, and convenience as unquestionable financial truths. But legally, bank deposit is not stored property, it is a loan you give. The moment money enters a bank, ownership quietly changes hands under contract law and regulation. Your balance is not cash in a vault, it is a liability recorded on bank books. The bank owes you repayment, not possession, similar to any unsecured creditor relationship. This structure allows banks to lend, invest, and leverage deposits to generate profit continuously. Without this legal transfer, modern banking, credit creation, and economic expansion would collapse instantly. This system works smoothly during calm periods when confidence flows and withdrawals remain predictable. Trouble begins when fear spreads faster than liquidity, and everyone demands repayment simultaneously. Banks never hold enough cash to repay all depositors at once, by design. They rely on confidence, central bank support, and legal protections to survive stress events. To prevent panic, governments built deposit insurance schemes promising protection up to fixed limits. In the United States, the FDIC insures deposits, but insurance does not equal ownership. Insurance pays later, after failure, and often only after legal and administrative delays. It preserves confidence, not immediate access, and certainly not full depositor control. During normal times, these distinctions feel academic, boring, and irrelevant to everyday life. But during crises, they become painfully real as access restrictions appear without warning. Banks can legally limit withdrawals, delay transfers, or freeze accounts under regulatory authority. These powers exist precisely because deposits are loans, not customer-owned stored assets. History offers brutal reminders of how quickly access can disappear when systems destabilize unexpectedly. In Cyprus during 2013, depositors woke to locked banks and frozen accounts nationwide. Funds above insured limits were seized and converted into bank equity through bail-ins. No crime occurred. The process followed existing law designed to protect systemic stability. In Greece, capital controls limited daily withdrawals, trapping savings inside collapsing financial institutions. Citizens technically still own balances, but could not use them freely when needed. The illusion of access shattered, revealing deposits as conditional claims, not guaranteed money. The law prioritized national stability over individual financial freedom without apology or hesitation. Lebanon demonstrated an even harsher reality when banks imposed informal but total withdrawal freezes. Depositors were trapped for years, watching life savings evaporate through currency collapse and inflation. Courts offered little relief because banks operated under emergency powers and political protection. Again, legality shielded institutions while ordinary people absorbed losses silently and permanently. These events were not accidents, conspiracies, or rare anomalies limited to unstable countries. They were stress tests revealing how banking law functions when confidence finally breaks. The rules always existed, but prosperity kept them hidden behind smooth digital interfaces. Crisis strips interfaces away and exposes the raw legal machinery underneath modern finance. In the United States, similar mechanisms exist, though rarely discussed publicly or politically. Emergency powers allow regulators to close banks, restrict withdrawals, and override contracts. The 2008 crisis saw extraordinary interventions preventing collapse, but rewriting rules overnight. Banks survived, markets stabilized, but depositors learned little about their true legal position. The concept of bail-ins now exists globally, including within us and European frameworks. Bail-ins convert creditor claims, including large deposits, into equity to recapitalize banks. This protects taxpayers but sacrifices depositors beyond insured thresholds without negotiation. Again, depositors are creditors, and creditors absorb losses during insolvency by definition. Digital banking intensifies this reality by removing physical cash from daily circulation entirely. Most money now exists only as ledger entries controlled by centralized financial institutions. This enables instant freezes, monitoring, and restrictions without physical barriers or visibility. Control becomes software-driven, quiet, efficient, and legally justified during emergencies. As cash usage declines, dependence on banking systems becomes absolute for survival. Rent, food, transport, healthcare, and employment all require digital payment access. A frozen account becomes a functional exile from economic life within hours. No crime required, only policy, regulation, or systemic risk declarations. This is why understanding custody matters more than interest rates or mobile banking features. Custody defines who controls access, who bears risk, and who absorbs losses first. Banks do not safeguard money like lockers. They transform it into fuel for markets. Depositors trade control for convenience, often unknowingly, until conditions suddenly change. Most people discover this truth only when access disappears and explanations arrive too late. By then, legal contracts signed years earlier quietly enforce outcomes no one anticipated. Trust replaces ownership, and trust is fragile under political, economic, or financial stress. History shows trust always breaks eventually, somewhere under sufficient pressure. Modern finance is built on promises layered atop promises, sustained by confidence alone. Deposits fund loans, loans fund growth, growth funds stability. Narratives sold to populations. When growth slows, narratives weaken, and emergency rules replace marketing language quickly. At that moment, depositors learn they were participants, not owners, in the system. This is not an argument against banks, but against illusions surrounding their structure. Banking is powerful, efficient, and necessary, but it is not neutral or benign. It prioritizes system survival over individual access, by design and legal mandate. Understanding this truth is the first step toward realistic financial self-defense strategies. Once you understand deposits are loans, the next question becomes who controls risk when confidence finally collapses. The answer is not you, your bank manager, but regulators, central banks, and emergency legal frameworks. These frameworks activate quietly during stress, prioritizing payment systems, markets, and institutional continuity above individuals. Stability becomes the objective, even if it requires suspending access, contracts, or expectations held by depositors. Central banks exist to protect systems, not savers, despite public messaging suggesting otherwise during calm periods. Their tools include liquidity injections, asset purchases, resolution authority, and coordination with treasury departments. When banks fail, central banks decide which liabilities survive, which convert, and which absorb losses. Deposits above insured thresholds are designed to be flexible shock absorbers, not sacred untouchable balances. This logic underpins the global shift from bailouts to bail-ins after the 2008 financial crisis. Taxpayers once absorbed bank failures, creating moral hazard and political backlash across democracies worldwide. Bail-ins flipped responsibility, forcing creditors, including depositors, to recapitalize failing institutions internally. The change protects public finances while embedding depositor risk deeper into everyday banking relationships globally. Legal language around bail-ins is deliberately technical, obscure, and rarely discussed outside financial policy circles. Most people never read resolution plans, living wills, or recovery frameworks governing their banks. Yet these documents explicitly outline how deposits may be restricted, converted, or delayed during insolvency events. Ignorance is not accidental. Complexity keeps confidence intact until intervention becomes unavoidable suddenly. Deposit insurance is marketed as a safety net, but it functions as confidence theater during systemic stress. Insurance funds are finite, slow-moving, and reliant on government backing during large-scale failures. During widespread crises, payout delays can last months while legal processes unwind bank structures. Meanwhile, daily life requires liquidity immediately, not eventual reimbursement after procedural resolution concludes. The 2023 regional banking failures in the United States offered a controlled preview of these dynamics. Authorities guaranteed deposits selectively, not because of law, but because panic threatened broader contagion risks. This revealed an uncomfortable truth. Protection is discretionary, not automatic, dependent on perceived systemic importance. Confidence survives when governments choose intervention. It collapses when they choose restraint instead. Digital money accelerates these asymmetries by removing physical exit options previously available to depositors. Withdrawing cash once allowed temporary autonomy from banking systems during uncertainty or distrust. As cash disappears, escape routes close, forcing dependence on institutional permissions for every transaction. Digital custody replaces physical possession, shifting power decisively toward platforms and regulators controlling access. Central bank digital currencies promise efficiency, inclusion, and stability, while embedding unprecedented control capabilities. Programmable money allows restrictions on spending categories, locations, timeframes, and compliance conditions automatically. What begins as policy tools can become behavioral enforcement mechanisms during emergencies or political stress. Deposits evolve from neutral money into conditional access tokens governed by centralized rule sets. This transformation reframes wealth from something you hold into something you are allowed to use. Permission replaces ownership, and compliance replaces autonomy within the monetary system quietly. Under such systems, dissent, sanctions, or classification errors can freeze economic participation instantly. No force required, only revoked access through software updates justified by policy objectives. History shows that monetary control always expands during crises and never fully retreats afterward. Emergency measures introduced as temporary become normalized infrastructure once fear subsides. Banking regulations tightened after depressions, wars, and collapses remain permanent fixtures today. Each crisis ratchets control upward, reducing depositor agency incrementally but irreversibly. This does not imply collapse is imminent, but it guarantees asymmetry during future disruptions. Institutions prepare for stress long before individuals recognize warning signs in daily life. Those closest to policy exits move assets early, while retail depositors react last. By the time access restrictions appear, options have already narrowed severely. Understanding this reality reframes financial planning beyond savings accounts and nominal balances. Liquidity becomes strategic, diversified across jurisdictions, instruments, and custody models. Risk management shifts from returns toward access resilience under adverse scenarios. The goal becomes optionality, not yield, when systems face political or economic stress. This perspective challenges comforting narratives about safety, insurance, and institutional benevolence. Banks are not vaults. They are leveraged intermediaries governed by systemic priorities. Deposits are not possessions. They are claims contingent on stability and regulatory decisions. Trust functions until it doesn't, and history shows it eventually always breaks somewhere. Financial literacy therefore requires confronting uncomfortable truths rather than clinging to reassuring slogans. Ownership, custody, and control must be separated conceptually to understand real exposure. Without this clarity, people mistake convenience for security and access for rights. That confusion becomes expensive precisely when clarity matters most during systemic stress. The future of money favors efficiency, traceability, and centralized oversight over anonymity and autonomy. This trajectory is rational from institutional perspectives, managing scale and complexity, but it demands individuals adapt expectations about safety, access, and sovereignty accordingly. Ignoring this shift does not stop it. It only ensures surprise when conditions change abruptly. Deposits will continue functioning normally most of the time, reinforcing dangerous complacency. Crises are rare but decisive, reshaping wealth distribution faster than decades of routine growth. Those prepared survive disruptions with flexibility. Those unprepared absorb losses silently. The difference lies not in prediction, but in understanding structure before stress arrives. Modern banking is not evil, but it is not personal, moral, or protective either. It is a machine optimized for continuity, not fairness, resilience, or individual security. Learning how that machine allocates losses is essential for navigating future instability intelligently. Only then can individuals make informed choices within systems designed without their interests. First, history never announces its turning points politely. It reveals them through restricted withdrawals and frozen balances. By the time headlines appear, rules already shifted quietly behind legal curtains. Understanding deposits as loans prepares you psychologically and strategically for those moments. Illusions dissolve quickly under pressure. Knowledge dissolves panic and enables rational action instead. If this story gave you a new way to see money, power, and ownership, subscribe. History repeats because people forget structures while trusting appearances built for calm times. This channel exists to strip appearances away before pressure exposes them painfully. Stay curious, stay skeptical, and remember, access matters more than numbers on screens.